Hi, everyone. Welcome to the first of our fall season of Oceanside Chats. Today with us, we have Christopher Yang of Tech Coast Angels. He is obviously here because one of his main roles is that he serves in organizing relationships with universities and other VC groups. And so he's one of hopefully many TCA members who will come through the garage and do speaking engagements and meet with our teams. He also does outreach and other events for TCA. Other notable facts about Chris is that he's a leader in technology and project management. And through those skills, he is an instructor at UCLA. He serves as a member of the Ford's Technology Council and provides information for articles that come out of Forbes in regards to project management. He's the VP of Engineering at the Corporate Travel Management Company, and he is USC alum. And so he's coming back out of the goodness of his heart to support all of the Trojan family. And through his education, he's gotten degrees in industrial and systems engineering, computer science, and computer engineering. And he's got a boatload of certificates, which I won't list now, but I will let him take the stage and speak a little bit more about himself and kick right into his presentation. Thank you so much for being here, Chris.
Thanks for the introduction, Rosalia. Yes, before I get started, as Rosalia mentioned, I'm affiliated with TCA. And also with Forbes as a contributor. I write about technology, project management, and also with CSQ magazines. Recently I published articles related to raising capital in the time of COVID. So I'll touch on some of those in more extent today. I post some numbers from PitchBook just yesterday to back up some of the assumptions and analysis I made earlier, and then I'll be happy to go over those numbers with you all today. In addition to my professional career at a CTM, Corporate Travel Management, which is a global entity based in Australia. We're publicly traded in the ASX exchange in Australia, and number 5th in the world in terms of TMC, travel management company. In addition to that, I do a bit of teaching on project management at UCLA. I also do a lot of guest judging. Most recently appear as a panelist at Startup Boost this Monday. And also Pitfalls Venture. I'm not sure if any of you have participated. It's just ongoing right now. I'm one of those guest judges as well. I've been networking with USC, the Garage, Marshall School pretty frequently, trying to contribute back to the children community. That's a very brief overview and introduction. So without further ado, let's get into today's agenda. So as promised, I'm going to go over some of the statistics, the trend of what's going on in the COVID environment right now, particularly in the startup landscape, in relation to investment size, deal flow, and valuation currently. And then I'm gonna cover some of the key factors related to investment and COVID environment, some of the factors that investors will specifically look at currently. And kind of go over TC's fund and our portfolio mix as of right now, so you can kind of understand how that correlate with the overall market and trends, and also give you a more specific sample size for the LA market in general, Silicon Beach. I allotted maybe 30 minutes toward the end for Q&A. Arcelia will moderate that part at the end. In case you guys have questions, and I'm happy to address all of them at that time. Alrighty. So these data are pretty updated. I went back to PitchBook last night just to kind of pull the latest When we say COVID, I kind of want to use April to October. I have some November data points, but let's just try to stick with the last 7 months before the election. And then kind of do a comparison between the same period of time in 2019, right? So what are some of the trends that are happening in the seed and pre-seed investment landscape? So I think most notably, we see that there's a significant jump in the IT information technology sector, going from 18.7% in 2019 to where we are right now is 44% in terms of all the investment that were made between April and October this year. That's a pretty significant jump, right? And I mean, we're going to see some winners and losers in terms of like by sector. And unfortunately, with the more B2B sales, B2B type of businesses, we do see a dramatic decline. It was going pretty well in terms of getting funding, getting investment back in 2019. They were roughly 10, 11%, and it's going down to, actually I take that back, it was 25.6% in 2019. It's going really down to just 12.7 this year. So hopefully these are good metrics that you can use to judge in terms of like how you should price and then come up with your deal terms when talking to investors, and also come up with a more reasonable valuation when you do your pitches. One important fact to note is that we notice 86% of the company that were seeking capital between the past 7 months, are seeking capital for the first time, right? So it's a significant trend. It seems like angel investors are looking for new ideas, new companies. Obviously, they're willing to build out some of the more promising companies within their portfolio. But it seems like a lot of companies and startups that were or are still under the water are looking for more federal loans, PPP loans, in terms of like keeping the business afloat as opposed to going to a down round, which is sometimes not preferable for previous investors and entrepreneurs. So if we were to take a closer look at the verticals, we see that there's increase in life sciences. So see, in terms of total investments, double in the last 7 months versus the same period last year in 2019, and also increase in lifestyle companies, wellness. I mean, lifestyle, sustainability and healthcare has gone up from 5% to 10% in terms of getting funding and investments. Again, these are total investments, not deal counts. Cryptocurrency, that's an interesting one. It's almost it's 8 times, 9 times more than getting in terms of total funding. Mostly probably due to some market uncertainties and also uncertainty related to the US currency and blockchain and those technologies being up and coming. So these are interesting trends, things to consider, right? The reason I want to touch on these statistics is that it plays a factor in terms of when you go out and talk to potential investors, the type of valuation you might be getting if angels and pre-seed investors are looking for these type of deals and you are not in these sectors or in these verticals. I mean, there are a couple of things you want to consider. Maybe is you probably want to delay your bootstrap a little bit and try to come in at a later time in terms of seeking capital. Or you want to probably apply a little bit of discount to make the deals and terms a bit more attractive. And Arcelia, are you able to see the whole presentation, or because I do see like my images and other things overlay on the slide. I'm not sure whether
No, I see your
that's
presentation
okay.
perfectly.
That's good. I'm just a little worried.
Yeah, no, don't worry.
Yeah,
It's just, yeah, you did it perfectly. Presentation mode.
Awesome. Yeah, presentation mode. So,
Yeah.
so these are the numbers in the last 7 months in terms of post-money valuation, right? We do see some irregularity between April and October, and you have to like understand that probably some of the numbers in April were started in March or earlier, and they were just closing in April, right? So these probably were valuations prior to that and negotiated prior to the pandemic has started. And you start seeing a dip in terms of like valuation sizes. And then there's some irregularity in July, August, and then coming down again, and then coming back again, right? So this is somewhat unusual compared to prior year where the average is roughly around 2 million. I would say that a sweet spot will be anywhere between 2 to 9 million. So and these are the type of deals I've been seeing from TCA, as well as some syndicated network, and also even pre-seed ideas are coming in when I was judging at several events these past months. So deal size still pretty similar to last year's number. I will probably take the October numbers out of the equation temporarily since we don't have November, December numbers yet, and that does seems like an outlier. It's hard to see anything that's over a million in terms of check size, but it kind of makes sense that we're averaging around, I would say, 100K between all the pre-seed and seed investment. I take that back. It's 0.1. Yeah, 0.1 million. And then it's pretty consistent with prior year number. So in terms of individual check sizes, I think a lot of you might be interested. That might be one of the questions that you want to ask. For angel investors, we're typically we write checks anywhere from like 25K to 50K per investment. But if you look at angel investment fund, the ones that have led in the past months, we're looking like anywhere between 100 to 300, depending on the interest. So you have a pretty good deal.
Quick question, Chris.
Sure.
Regarding this table, it looks like the metrics from the left and the right-hand side on the y-axis are different. So,
sure.
So the quick question that I had from the chat is which side is correct? So one of them is like 2.3 million, and then the opposite side on that same y-axis is 20.
I think one of them is for the total capital invested. That will be the higher ones on the right, and the other one is the deal size for individual deals that were coming in. So yeah, these are the left are for the bar charts, and
then the right is for the
trend lines. Yeah.
Got it.
Mm-hmm. And I'm happy to share these decks afterward as well, in case you guys want to like own these matrix and help them use them to guide your I would say when you're drafting your pitch decks and your business plans. So moving ahead, I think it's important to look at to summarize pretty much what we've looked at already between 2019 and 2020. It seems like the total deal counts has come down a little bit, 27.5%, going from roughly a little bit over 200 deals in 2019 to 221 deals in this year between April and October. Interesting to see that pre-money valuation has been fairly consistent. You do see a bit of more shares being acquired, and then the post-money valuation has gone up just a little bit more. Again, these are average numbers, like median numbers, and we're pretty much excluding the outliers. That's why the numbers look a little different from previous slides. And so, but the caveat is that from the deals I've seen, right, even though like the valuation has been consistent, I think the deal terms has been somewhat better from investors' perspective. And again, it really depends on the industry and sectors that you are in, right? So if you're in the IT and healthcare, as we talk about, or healthcare and fitness and health sciences, you probably get a more consistent valuation versus that you are in potentially doing something in the retail space or travel space. Moving full speed ahead, I think it's important to look at a smaller market, right? Just LA, right? Because TCA is primarily focused on the Silicon Beach area, and we have 5 chapters in the LA metropolitan area, LA, where I'm part of. We also have the Orange County chapter. Outside of LA, we have the San Diego chapter that's pretty big. We have one in Ventura and one in Inland Empire. So out of the LA deal we have completed in 2020, I mean, these are the companies, our portfolio companies, just to kind of give you some sense the type of companies that we're investing in right now as compared to the whole United States. And this is the portfolio mix. We have a good number of digital mobile app product companies, but also substantial amount of hardware software company. And then you see some life sciences, consumer products as well. Ready, Set, Go is consumer products on a previous slide. Clean tech is also up and coming. Just kind of give you some sense that the type of investments that TCAs have invested in and potentially will be looking to invest down the road. So I'm going to switch gear a little bit. I mean, we look at the statistic, we look at the trends, we look at the type of companies that are more likely to get funding, but those are not the only factors, right? So we also want to look at several other things, especially in this COVID environment. Number one, the team really matters a lot, right? So investor bet on the jockey as opposed to the horse. In most cases, you rather have a very seasoned, experienced team, preferably serial entrepreneur versus first-time entrepreneur. But that the equation changes from time to time. So if you are a first-time entrepreneur, you could equip your management team with very seasoned executives or talents, and also have a good board advisor. That changes the equation as well, right? But especially during COVID, right, we're looking for entrepreneurs who has the mentality, the flexibility, and the ability to pivot, right? So, I mean, many companies we've seen in the past has pivoted more than once before getting to a successful exit, right? So it's very, very important. Second is obviously a strong product market fit, right? So we're in an environment that's rapidly changing, right? I mean, obviously we're in a better state versus March, April, right? Back then or earlier in the pandemic, there's even more uncertainty, right? We don't know what a business is going to survive, what business is going to be going out of business. So it becomes very difficult. We want to be able to quickly bring product to market and to see whether the consumer's appetite has changed or not, whether they still enjoy the product, and because a lot of the market analysis probably is not as relevant anymore going to this new era, just put it that way. And more importantly, we want to make sure that there's demand in the next 6 months. So in case which allows the businesses to scale during pandemic and even after the pandemic. So that 6-month period is very important. Faster time to market important, allowing entrepreneurs to be able to pivot in case initial assumptions were not as accurate, and there's just time. to make changes and pivot pretty much. And then another important fact I want to call out is that investors are not just looking for ideas that could that would do well in the pandemic, right? So the idea needs to be sustainable in a way, and will be able to see continual growth even 3-4 years, or because typical in 3-4 years even after the pandemic. Because typical investment, angel investment, we're looking at anywhere between a 4 to 7 year exit, right? So that's technically what will pass the pandemic, and because we're foreseeing that things will start coming back again. And a lot of the solely recovering industry like travel, retail, I think 3 years, hopefully we'll come back to the 2019 sales figure. Moving on, realistic cash flow plan. I can't stress the importance of that, right? So ultimately, cash is a king. And you don't want to go up. You don't want to go bankruptcy, and just because you're running out of working capital. So the rule of thumb is, especially in this pandemic, where we look for 12 months working capital. You need to have a manageable burn rate, as well as a 12-month of runway, pretty much. It depends on the round that you're raising, as well as how you plan to use your fund in the next 6 to 12 months from closing. So I kind of touched on the next point a little bit: discount valuation in slow recovering sectors, right? It's not going to be the same. We foresee uneven recovery, at least within the next 3 years from now. So if your business, if your company is in one of those slowly recovering sectors, you probably want to take a step back to see, okay, right now before the pandemic, based on our pro forma, the valuation is roughly around 5 to 10 millions. Is it still going to be the same right now going to this round, now that we're in pandemic? And a lot of the projections are probably no longer relevant, at least for the next coming months. So if I'm still seeking capital at this point, how should I adjust? How should I revise my valuation? And next, obviously, if you're in B2B space, right, which has been hit quite significantly based on some of the matrix I pulled, so you want to avoid having too much concentrated revenue, right? Because if it's B2B sale and then you only have a few big companies within your portfolio, it's really hard to predict how things might change in coming months. And you want to be cautious of that, because that could have a significant impact of your top line, and consequently will impact your cash flow and your bottom line. And I guess finally, last but not the least, the basics, right? You still want to have your strong fundamentals, making sure that great product, great customer propositions, at least something that has above average barrier to entry. You want to make sure that you're addressing a big enough market, something that's at least 200 million SAM, service attainable market, and something that will allow the entrepreneur, will allow the business to scale over time, right? So it's very important that as entrepreneurs, you understand the angel investment ecosystem, right? And the type of the deals that we're making, the type of company that we're looking for, right? And assuming 1 out of 10 companies will be a home run. When I say home run, we're not talking about like the unicorns, but just like something that will help provide above average return for the entire portfolio, right? So if we're looking at typically a 25% IRR annualized return for each year, right? And then to get that and to cover all the losses of the net companies, you're probably looking at something that's a 250% return annualized. And then if you multiply that by like 4 years, let's say you were to exit in 4 years, right? Really, the company we're looking at is something that has the potential to get us to 60x, 60. Obviously, that's not always the case, but we want to shoot for that. We want to aim for that. In case we come short, at least it's palatable for investors. So market size really matters. And other things to protect yourself ranges from IP, your go-to-market strategy, if you're in hardware, software, your distribution strategy, your marketing strategy, all that really matters. And I can't stress enough about the deal terms, because ultimately that's going to matter the most for your investors as well. I think that concludes the presentation portion of today's discussion, Solia. So I guess we could go into some Q&A.
Hi, yeah, can you hear me?
I can hear you, yes.
Okay, great. Let me just do one quick thing that I should have done a while ago. Oh, forget it. God, I hate Zoom. I love Zoom. I'm not gonna, Zoom is good, but I really also just hate it. There's a function that I should have set up before I started, which is to hide all non-video participants, but it's fine. I'm just gonna give up. Oh, there it is. Yes. Okay. Back on track. So that was really in depth. I super appreciate all of the data collection that you did to put that presentation together. Obviously, there were a lot of numbers to kind of digest there. So I'm going to soften up the conversation a little bit, just to ask some questions that I'm sure are, especially for early stage teams that are looking for seed funding, are interested in asking. So just to be clear to everyone on the call, like, I'm not trying to moderate the questions. I think part of the reason you guys are here is maybe you guys have questions for Chris yourself. I'm going to kick it off, but please, if you guys have a question. So for instance, I'm assuming Julian has a question because he turned his cam on. Is that right, Julian?
Yeah. Well, no, but, and also, yeah. And are you stopping recording or are we still recording?
Oh, we're gonna keep recording. Do you want to ask a no?
Yeah.
Okay.
Yeah, I've got questions. Yeah.
So I guess like the easiest cadence forward is if you have a question, turn your camera on, and then I will call on you, and you can ask that question. Let me ask, or actually, I was about to ask Taraj's question, but it looks like he turned his camera on, so I'm going to shoot it over to Taraj. Go for it, Taraj.
Sorry, thank you so much, and thank you. It was a great presentation. So I do have a general question, maybe not really related to our situation, which is COVID related, but in general, I know TCA is very competitive. You get a chance to pitch in front of you guys. What is the best way that you recommend for early stage companies to introduce themselves and potentially get the chance to pitch in front of you?
That's a very, very good question, right? And there are a couple of ways you could get your deals or get your companies into our pipeline, and or pretty much it has to go through our pre-screening committee, and then before it get presented to all the angels. I can kind of go through our process a little bit, right? So if you go to TCA's website today, you're able to submit applications from there, and you'll be asked a number of questions in terms of, pretty much all the stuff I've covered earlier. You need to talk about your product, your solution, the market that you're addressing, and so forth. Right? Very typical questions, even before your company can be looked at. And from there, it will go through a couple rounds. First, it will be a pre-screening round. You'll be meeting with our pre-screening committee, which consists of 2 or 3 members on our staff, and then it will ask you a couple questions, making sure that you answer all the fundamental questions. And if you pass that round, you will be taken to the bigger group, which we have like twice monthly meetings to kind of go over all these qualified deals. and you'll be given roughly 15 minutes time to present, and of which 10 minutes will be probably your presentation, and 5 minutes for a Q&A. And from there, if we have enough traction, we have enough interest in your ideas, in your company, we'll assign a lead, and we'll go through a due diligence process, making sure that whatever you said you advertise or you in your pitch deck actually correlates to the reality. And then if there's IP and patents, we'll try to verify them as well. And typically the process go from, I would say, a month to 45 days at most, and then you get an answer. And you just see a lot of individual investors coming in with like check size anywhere from 25K to 50K, or you get a large check from one of our funds. Right now we have 3 TCA funds going on. The check size for those funds are anywhere between 100K to 200K each. So those portfolio companies I talked about earlier are each getting at least a minimum of 100K investment from our fund. And more to that is you get that time from our entrepreneurs get time from our investors, angels, and will help mentor you guys in terms of either on the business development side or corporate strategy side, and try to put you in a better positions going forward. And the caveat is that if going from pre-screening to the screening round is not easy, just put it that way, right? It will be best if you could have someone, existing member that is willing to endorse you. That will be much easier to bring you your pitch, your presentation to a bigger audience.
Can I piggyback on that?
Sure.
2 questions. The first is there like, any advice that you can give to the teams on how to build those kind of more personalized relationships with those the angel investors, so that they can get an advocate in that panel? And then my follow-up question is, just so that we can get a little bit of the numbers from the pre-screening to the screening process, like how many teams do you guys look at pre-screening, and what does it get whittled down to typically? Because it's kind of nice to know what the real competition looks like.
Well, you have to imagine, right? I mean, this is a public domain that's listed out on the internet, and we get a lot of people submitting ideas and pitch decks, right? A lot of those ideas are half-baked, right? So probably doesn't have a viable go-to-market strategy, and the market size is not big enough. And more commonly, right, we get some very, I would say, unrealistic valuation, right? Like we've seen anywhere like 150 million valuation, right? There's no way an investor would come in and say, and then at that round, just put it that way, right? So, and so, although the numbers is not high going from pre-screening, I mean, or even getting from the lead into pre-screening, right? A lot of these will be probably taken out. And then we look at some deals. I mean, really comes down to perfecting your business plan, right? Making sure that you're checking all the boxes, right? I mean, it's very easy for us to pick out ones that are simply not qualify to make it to the, I would say, the screening round, right? I mean, it's easy to pick up bad ideas, but at the same time, it's difficult to find the unicorns, the home runs that will get us the returns that we're looking for. So this is a very, very, I would say, complicated type of investment strategy for angel investors. The second part of the question is related to relationship, right? And relationship doesn't build over time, right? So I think what I would recommend is that be proactive in getting yourself out to the startup community, making sure that you are constantly networking with different people, not just investors, but entrepreneurs as well. And sometimes I get referrals from a portfolio company that we've funded. The founder is a friend of another startup, and they speak very highly of this person in terms of their management skill, their talents, and then their personality more important, right? Because putting all the hard skill aside, right? When we're looking at the CEO or entrepreneur, right? I mean, you gotta have the leadership skill. You gotta have the domain knowledge, operating skill as well, right? But aside from that, right? I mean, we're looking for integrity, right? Someone it's just transparent and who's honest, who will make good use of the money we invest in, and also like the grit, so who could persevere in downtime, because like starting a company isn't easy, and it's actually very, very challenging, and I would say mentally challenging for the CEOs and entrepreneurs. So we want to make sure we're investing in someone that who could I would say do well in downturn, and also be able to scale the company as we move ahead, right? So these are, I mean, also need to be realistic and flexible. I mean, there are a lot of soft skills that we're looking for. So having that referral, that introduction really helps. I hope I answered your question.
Great, it was great. Moving on to Julian.
Yeah, hi Chris. Yeah, Julian from Open Sesame. So we actually have a really good relationship with Jim Pickel down in TCA, Orange County, and he's actually trying to set up an intro to you guys. So I know Steve, who's on the line, my COO. So we just chatted to him last week, but because so yeah, I just wanted to caveat that because it'll be we're already funded at pre-seed level. We're looking at a little bit of money coming in. So the questions I had, just really simple ones. So you were talking about the so I've got two. The first one is around you were talking about the non-slow recovering sectors, right? So
Yep.
And being realistic, right?
Yep.
Can we talk about the converse to that? So, you know, for instance, we're in like gaming and mobile. So what are the ones that aren't being affected by COVID and that they're sustaining their valuations or sustaining their growth? Yeah. So what have you seen so far? What's your opinion on that?
I would say you are on the right track for sure, right? So typically most of our investment we are in, I would say, post-revenue companies, right? I mean, I would say 60-70% of our 2019 investments were geared toward post-revenue companies, right? And I think just put some numbers in perspective. In 2019, in general, TCA across 5 chapters, we invested in 52 companies total, for a total of I would say 19 millions, which is quite significant for Angel Network. So just on that note, right? So if you are in industry or vertical that's up and coming, a lot more. I think as long as you have a good product market fit, and obviously you're not in a highly competitive industry, or your product is not competing against something that's a lot of mature product out there, right? I think you got a very good shot. You got a very reasonable shot in terms of getting a slightly higher valuation, and even be able to get investments prior to making profit or making revenue. So I think Sizzle is as a company that we recently founded. I was the deal lead on that particular deal, right? I mean, it's pretty much it's still the company just finished the POC stage. It's got a product that's ready to go to market, but there's no revenue, right? In the past, it's 50-50, right? I mean, it's much harder for angel investors to, at least from TCS perspective, right? Look at the data; it's only 60%, or less than 40%, right? So, but in this case, we funded a lot of those similar companies in mobile, internet, gaming, that are earlier in the stage, more in the concept stage.
Cool. And just in terms of the amount of revenue that you're looking at, is there a particular annual amount or a particular monthly amount when you're looking at that? You know, the 60-70%, like what you're defining as post revenue in that scenario?
Well, it's gonna be more than like a few grants for sure, right? Because otherwise it's pretty much considered pre-revenue, and more importantly, the type of revenue as well, right? And whether it's coming from your product, whether those are recurring revenue versus one-off, and also whether they are from real customer, beta customer, and so forth, right? So it depends.
Right.
But we consider everything.
And then because we've just come to understand this, the different TCA groups and the different specialities associated with them. So, for instance, I think the reason Jim's wanting to bring us to TCLA is because we're doing stuff in entertainment and in mobile and stuff like that. Do you want to just, is it possible somehow to get an idea the mix of the angels in the TCLA network and like where their specialities lie? Because, you know, for us, it's not just money, it's like money plus accelerating. And that comes normally from a network from that angel investor and like that sort of thing. So yeah, I mean, do you have that? I mean, just, it can be ballpark. Yeah.
I don't have numbers on that. But I could tell you all of the 500 angel investors within our network. We're talking about serial entrepreneur who have successful exit in the past, and you have seasoned technology or operation executives, and you got a good mix of people that are have specialty and also are experts in their fields, right? So I don't think that's something you need to worry about, and especially talking to a pretty big network like us.
Okay, cool. And then the final question is just around attributes of the founder. So obviously you're aiming for this 60x, which is amazing. Is there, now that you've come to see a lot of founders and people who've actually been successful in that sense and stuff, you talked about grit and a little bit like that, but is there something you can now just get a read whether they're going to succeed or not? Or is there particular things that you can already guess whether this is going to work out or not in the when they're presenting and that sort of thing?
Well, you could kind of tell, right? But a lot of them happens after the pitch as well. Let's say your ideas, your company is scalable, is viable, and we have to go through the due diligence process, right? Making sure that the numbers are actually accurate and get references from like previous investors or partners if possible as well, right? Just to kind of validate some of the assumptions, right? So at the end of the day, risks really matter, right? For investor, we try to, I guess for entrepreneur, you try to reduce your startup risk. So that way the deals will look much more attractive for your potential investors. And we're looking a way to make sure that we could reduce our investment risk. And to answer, I guess, I'm not sure if that answered your question. What was the second part of the question again? Sorry.
The question is just around like, can you get a read on whether that you're looking at an outsized return of 60x, but you're backing people very early? Is there something that you've done from now seeing a number of deals or founders that have been successful or not, certain attributes of that founder that when you first meet them, you go, I think they've got this? Or is that a fool's errand? Is there something an essence? Because you're coming in so early, it's like,
Well, speaking on the founder side, right, just to answer your question more precisely, it's hard by just listening to a new person coming in and do a 50-minute pitch. And so if we don't have any references, if this is just like you're coming code into this meeting and you try to convince us that this is a product, this is a company that we should put our hard-earned money into. So the argument has to be really strong, right? So either you have really very, very successful exits in the past, right? You have a 10x, 20x exit in the past that put us in a situation, okay, you've done it 4 or 5 times or 2 or 3 times already. The chances are a lot higher, right? Because starting a company isn't easy, right? It's not just the idea. not the vision, but execution is very important, right? How do I get this product to market? How do I pivot my product? How do I adjust my product so I could continue to attract new customers? So what is my we need to look at the economics, unit economics as well, right? And also how do we retain customers? That's it, as another thing if you're in B2B, right? So these are type of things we worry about, and if you have demonstrated that you have a path to that, you have done that, been there, done that before, it becomes a lot more. The argument becomes stronger.
All right.
Thank you, Julian. I'm gonna, is it Amir Nader? Did I say that right? I feel like
Yes, Amir Nader.
Okay.
So hello, thank you for giving us this opportunity. So I have a question about raising money for the pre-seed money. And since during the COVID time, there are some raise on the some platforms like vFunder or crowdfunding, basically angel funding thing. So I would like to know in terms for the pre-seed money, do you recommend to go through the process of getting the angel investor in the traditional way or going through this crowdfunding actually investment platforms, and which one do you more recommend basically?
Well, from an angel perspective, I would probably recommend that you go through the traditional like pre-CC fundraising path versus trying to raise equity, right? There's a difference between like equity crowdfunding versus like you just consumer crowdfunding, right? So if it's equity, that's a different story, right? You end up getting a pretty, I would say, complicated cap table with a lot of like people owning equities, and probably that's is not a good sign, or not something that but your future investors will want to see. But there's really no right or wrong answers to that.
But don't you think that because there is during the COVID time there is a raise on the people who are basically the micro angel funders, micro angel actually investors, and it's easier for convincing those people than angel investors, or no?
Yes, I guess maybe I wasn't clear initially. That I mean, yes, some of those crowdfunding platforms are good in terms of like funding your product. I think that's good, but just maybe not go down the equity crowdfunding route. Just it's a good idea if you just like getting capital to validate your assumption, validate your POC, and making sure that you could create a, I would say, supply chain or distribution network that allows you to scale your consumer product down the road.
Thank you.
Kind of test it out. I mean, that's a good idea. I'm not against that. And actually will work in your benefit as well when you speak to potential investors.
Thank you. Okay, I'm going to ask John Francis to go, and then after that, Alex, you shoot, okay?
Great. Yeah, thanks a lot for talking with us today. It was cool to see the different segments growing in particular. That's a good graphic. So I guess my question is, first I had a little bit of confusion on the way the organization operates, and if everybody is necessarily funded into that pool for 100K amount, or if there's other options there. And then as far as the arrangement and investment, how you guys do it, whether it's safe notes or if you prefer a straight valuation at the time of investment, so on.
A very, very good question. So, well, 100K is the investment size that's coming out of the fund, right? So, I mean, it really depends on the round you're raising, the capital that you're looking, and I guess from the fund's perspective, right? Well, the fund size is typically anywhere from 1.5 million to roughly 2 or 3 millions in terms of total fund size, right? So we want to diversify, but also don't want to over diversify as well. So we're looking at roughly 10 to 15 investment per fund at the moment. So that's how we decided that there's 10K, 20K will be a sweet spot to go in. But for individual investors, you could probably get checks. I've seen as small as 10K, for some of the deals I've led. But you're most likely going to see 25K to 50K. Those are the average check size. And in terms of the type of deals, I guess convertible notes is a very common, very popular ones. We have done some SAFEs as well, and equity financing such as preferred stock as well. If you are in later stage of the fund, of your fundraising, yeah, something more like a bridge round or past UC.
Is that trending any particular way from what you've seen over, I guess, the past year or two?
Not necessarily. Safe is easier. You don't worry about the discount rate and all the complexity as part of it. And so I've seen a lot more people doing that. But I mean, there's not a particular trend that whether we get more of this or that.
Great, thanks. Okay, Alex, you still there? You're muted. You're muted.
Sorry about that. Chris, thank you so much for taking the time to educate us a bit today. So from a risk mitigation perspective, something I wanted to ask, what we probably don't want to even think about right now, but how do you typically execute on portfolios or investments that are not performing?
Well, I have half the company we invest will end up going out of business, right? And then probably the remaining 20-30% will break even. We'll have an exit of 2 to 3x, right? So you really need to bet on one of the companies being those home runs, as I discussed earlier, right? So something that's with an outsized return of like at least 10 to 20x, right? So the portfolio strategy is that you want to be constantly invest throughout the course. So you have exposure to a good number of portfolio companies, right? A good number is you need to minimum 25 or more, right? If you could get to 100, I mean, but that's a lot of money that we're talking about, that you could probably have a 2.5x return over time, or somewhere around, I would say a 25 to 30% annualized return IRR. Yeah.
Thank you.
And thanks, Alex. Now, I know we have a few people who asked questions in the chat that I don't know if, so Janet, I'm not sure if you're comfortable getting on camera to ask your question, so I'll just ask it for you. Janet says, how does TCA view tech-focused social enterprises?
I think it definitely owns a position in our portfolio. It ultimately depends on, I mean, obviously we as angel investors, right, we also want to invest in ideas that can bring better goods into the community, into our society, right? That's an important factor, right? But not the only factor, right? At the end of the day, the business plan has to be viable. The idea has to be scalable, and the teams has to be able to execute on a strategy.
And then since we're at the end of time and I don't want to keep anyone over, I'm just going to ask one more question and then I'll wrap it up. It's basically, do you have any parting advice from your experience as an investor in the Angel Network? Something that you've seen, or any like sage words for these teams who at some point are desperately going to be knocking on many people's doors asking them to believe in their product?
Not so much on the product development side. I mean, it's, but I have one, I guess, advice is that you want to be able to, you want to bootstrap as much as you could before seeking capital, external capital. I think that's very important. And you also want to raise just enough to get you to the next round, to validate your product, to test the market without over diluting your shares. And then be wise, spend your money wisely, don't overspend, making sure that every dollar counts, every month, every piece counts.
Great. Now, this is specifically for VSG teams. Chris is going to share his calendar with me so that you guys can have some time to speak with him privately based off of your actual businesses, your business model, and maybe even get some feedback on your pitch and pitch deck. He's been gracious in giving us his time. So stay tuned for more information on that. Otherwise, thank you so much, Chris, for joining us today. This was really informative. I do truly hope that we can bring you back and other TCA members to come do something similar. I think it was really valuable for everyone who's on the call. So thank you again, and have a great.
It's my pleasure.
Bye, everyone.
Yep.
Thanks, Chris. Bye, guys.
Thank you, everyone.
Thank you.